In the game of loans, you either win or you learn. Welcome to the game of loans, where fortunes are forged and empires are built. Your hosts, lords of lending and wholesaling, are here to guide you through the realm of real estate and wealth building. Brace yourselves, cash flow is coming. Welcome to the game of loans. I'm Steve Afra. I've been in the lending business for over 30 years, and yes, that's correct. I'm not that old. I'm here with my business partner, Ras the Boss. Go ahead, Ras. Introduce yourself.
Hey guys, I'm Ras the Boss. I've been in the private lending and real estate business for 20 years, responsible for over $5 billion in transactions. We know what we're doing here, and we're going to show you all the tips and tricks in real estate that made us very successful.
And I'm Dustin Ring, the wholesale king. I buy and sell real estate without ever using any of my own money. I've done over 600 transactions in the last 6 years, and let's make this thing happen.
So today's episode, we're going to talk about how leveraging and debt basically created this great country, and how all these massive real estate companies and real estate investment firms, and the like, use that today, and they've been using it for 100 years to basically build their empire. Russ, what's some of the things that you want to tell the audience about being able to leverage and using that leverage to kind of 10x the money that they have, so they could buy more real estate, but obviously responsibly?
Yeah, I mean, our country's been using debt since the beginning of time. Banks use leverage. They leverage your money, the deposits, and they turn around and finance you and provide leverage so that you can grow your portfolio. The amount of leverage you put into a specific investment is dependent on the quality of the collateral and the quality of the sponsor who's getting the debt. Leveraging your real estate portfolio can 2 times, 3 times, and even 10 times your gains, depending on how you use that debt. Debt's one of your biggest allies. A lot of people are afraid from leverage, but if you're smart about it and you know how to manage risk, it can make you a very, very successful real estate investor. Let's switch over to Dustin. Tell us a little bit about your business and how you use leverage.
So, when I first started in the game, I didn't actually buy houses. I didn't have credit to buy houses, and I didn't have money to buy them. And now I'm able to grow my business faster than I think I could ever do, because I don't have enough cash to buy the properties that I buy. I mean, if I was using my own money, my own cash out of my bank account, it would take me 10, 20, 30 years to probably buy the properties that I bought just this year. Mm-hmm. And so being able to leverage the banks and use other people's money and have that good debt. I've still got equity in my properties. My properties are cash flowing, but I have that good debt. And, the more I see it go up, the more happy I am, because I know that's more assets that I have. And so that's, I don't have a whole ton of experience when it comes to, financing a lot of things. Only property. That's all I do, is I buy property and I use the bank's money.
So something you touched on, I think, is OPM, right? Other people's money. And I think that's very important. Ross, one thing, we have obviously, from the business that we do, we know when somebody is in a good situation and using debt properly, and then other people that aren't. Can you give an example of what would be a bad way to kind of use debt, or over leveraging is also bad, right? And how somebody could gauge that, where leverage is good, but over leveraging is fucking horrible, and it could take the house of cards down.
Yeah. So first off, I think it's helpful for the audience to explain what leverage is. So leverage is just borrowing money against an asset. Now, in real estate, leverage is different than if you're borrowing it against stocks or you're borrowing against a different asset class. So in real estate, for an investor, you can typically expect leverage up to 80 to 90% of the collateral value. And so the way that you calculate out leverage is how much equity you have in the property versus how much debt you have. So if you financed a property and you put 50% down, you have 1 turn of leverage. If you put 20% down, you have 4 turns of leverage on that asset. Now, to Steve's question about asking about what are some scenarios that leverage may be bad or put you in a bad situation, there's a couple of them. The first one is leveraging volatile asset classes, so things that move up and down dramatically in price. And so, for example, like stocks, you can typically leverage most stocks at 3 to 4 times your equity position. So that means for every dollar that stock goes down, it goes down $4 in cash. So if you don't have cash reserves to meet that, they do what's called a margin call, and they'll sell your stock to get repaid on the debt side. And stocks are very liquid, so getting leverage at those levels is very reasonable. On less liquid stocks that don't trade very often, they'll give you less leverage. In real estate, your risk on leverage is cash flow related. And so if you take out more debt and have a monthly debt service that more than that asset brings in cash flow, you have what's called negative cash flow. Or if that property for some reason is vacant for a number of months, you have 0 cash flow on that asset. And where we see issues is those real estate investors don't have enough reserves to cover those missed payments or the shortfall in cash flow. Well, leverage can be your ally in a lot of cases as well, because in lieu of selling a property, you can do what's called a cash out refinance, which has no tax consequences. You can pull equity out of a property, put a little bit aside for reserves so that you can make your payments, and then use the other equity that you pull out of that property to go out and acquire more assets, and in turn leverage those up and improve your overall cash flow and the amount of assets that you have under management, which should appreciate over time as long as we're not in a black swan event or a crazy market like the pandemic or 08, a real estate market crash.
I'm going to go to Dustin because Dustin does something really special too. But on that, I would also add that besides asset classes, timing has a lot to do with it, right? So where, especially in real estate, if you're really leveraging at a high amount, right? So let's say you're borrowing 90% of the asset, right? And you don't time it right. And usually, as we know, aggressive lending happens when the market's very lucrative, right? But usually it also happens when the market's right about to tip. So I think timing also, you would say, has something to do with that, right? Because if you're buying at the height, right, of the market, and then something happens, recession, something, and then it's time for a downturn, now your 90 LTV, it goes to 120 LTV. So now you owe more than the property is worth, and you're pretty much shit out of fucking luck.
Yeah.
Right?
To piggyback that part, on the timing side specifically, it's something called a mismatch in assets and liability. So if you borrow 12-month money from a private money lender like us, but you need 3 years to stabilize that asset, you have what's called a balloon payment where the full note's due after the 12 months, but you need another 2 years. Well, if you're in a market where financing is harder to obtain or interest rates are higher, you may not have a financing option to get out of that. And that's another scenario where timing is a big proponent of, whether or not you should elect for leverage. And I would always tell people, go out with moderate risk at first if you have the ability to put more equity into a project. But some of the most successful real estate investors I know have leveraged through the gills and have gone out and taken out as much debt as possible. Sometimes you need some steel cojones to go out there and really make it big. So don't be overly cautious, but understand your downside risk and make sure you know how to manage through that properly.
So
you really got to know your market too. Like if you're one of these newer investors, we got a lady in our market who bought probably 10 houses on the wrong side of town and ended up, getting HELOC loans on them or, home equity loans. And she ended up fixing them up. They're all real nice, but they're all in danger zone areas. And she couldn't get, she wanted to get her money back, but she was basically upside down in these houses. They gave her the money, but nobody's going to pay what she owed on these houses or what she needed to get out of these houses. So she was using other people's money and using what could have been good debt, but she ended up screwing herself because now she's sitting here with all this debt and nobody wants to take that away from her. She can't sell it. She doesn't want to rent it. And so that's just another story of, you can use debt and it can be great, but you can also screw yourself if you don't know what you're doing.
So on that, I think one of the biggest losses, actually not one, the biggest loss I ever took in the lending game, and the guys out of Vegas that went down to Houston,
Yep.
right? So these guys, like you said, they were so successful in the Nevada Las Vegas market, right? And they figured that they could duplicate the same thing if they go down to Texas. Now, one thing about Texas, and no offense to Texas, but Texans usually don't fuck Texans. You know who they fuck? Out-of-staters, and they don't give a shit. So these guys went down to Houston, and they started buying up properties thinking that they're going to have the same type of success.
Right.
Meanwhile, the Texans were selling them all the garbage, all the homes that had just recently been flooded and had black mold and just fucking junk and everything like that. And these guys got stuck, holding the bag, and I'm the one, like an idiot, that lent them the money.
Gotcha.
And I took a good licking, about $3 million. So that's something, like you said, you have to know the market that you're doing it.
Right.
But I have a question for you, because there's multiple types of debt, right? Especially in your game, you also get financing from the seller, right? So you do seller financing.
Sometimes.
As well. Sometimes.
Yeah.
Can you explain what that means? What is seller financing? What's the difference between seller financing or coming to someone like me and Ross?
Well, seller financing is basically where the homeowner acts as the bank. So you're going to tell them, hey, I'm going to give you, and sometimes you can give them a down payment. It depends on their motivation. Also, it depends on how nice the house is, if I really want to do a seller finance deal. But basically,
you want it to be nice, or you don't want it to be nice?
Typically, I want it to be nice because I don't want to have to do a bunch. It all depends on the cash flow, and we could get real detailed into the numbers and everything, repair costs and all that. But typically, what a seller finance is say, hey, I want to buy your house, but I don't want to use cash and I don't want to buy it outright. I just want to make payments to you. A lot of times it could be in a foreclosure situation where I'll just ask them, hey, if I take over your payments, would you be good? And most people are going to say yes, unless they're in some dire situation where they need a lot of money fast. And even in these owner finance situations, you can make a down payment. So sometimes I might go, I'll give you $5,000 or I'll give you $10,000 and 0% interest, 1% interest. It all depends on what you negotiate with that seller. And so usually a seller that owner finances you a property, first, they don't really have any, I guess, lending sense. So they're going to basically listen to you on what your options are. That's what I've mostly seen. So, we'll find a fair interest rate, and then basically you can just sublease that property. A lot of people that aren't investors, they'll look for those owner finance houses because their credit sucks, or they don't have proof of income, or they can't go to the bank and borrow the money. So they'll go to a private individual that owns a house and say, will you basically rent to own me this property for a certain amount of money every month? And essentially, they'll sign a contract, and as long as that contract is never voided or they don't do anything to disrupt the contract, that is now their house. So that old seller, the old owner that sold you the house, they're just like Regions or a local bank now. They're not the owners anymore. You're now responsible for the repairs. It's like it's your own house. So you can do what you want with it. You can fix it up and sell it. You can sublease it. You can get another tenant in there. So if you agree to $400 a month for the owner finance deal, but it'll rent out for $800 a month, you can go find another tenant and put it in there. But essentially, owner financing, it is buying a house, but you're not having to get approved for a loan. It's just a basic handshake and a contract between two private parties.
What do you typically see as the motivating factor on the owner finance side? Is it the payment? Is it the rate? Is it the duration of the repayment? Is there a certain profile of people, somebody who's more wealthy that wants the cash flow, not necessarily the money now, versus somebody who's in a rush to sell?
Sure. A land you can do owner financing much easier, but typically with houses, from what I see, and I'm no owner finance expert. I've done a few deals, but I don't hunt for owner finance deals. My thing is, can I wholesale it or can I buy it? I will sometimes offer that, hey, let me take over your payment. Like, for instance, I had a lead today that called while we were on the way down here to Nashville, and she's he had bought the house in 2019, and it's a nice house. He needs to sell. And I'm like, well, you bought it in 2019, so you must have a pretty good rate. Probably paying $400 or $500 a month in 2019. And so I said, well, how much are you paying a month? And he says, well, I'm paying $1,200. I'm going, you must have refinanced. But if he hadn't have refinanced and he was paying $400, he's about to lose the house. Let me add you that. So they're knocking on the door. They're about to set an auction date. He doesn't want to lose his property. He'd like to walk away with some cash in his hand just to maybe start over. So that's no problem. But say he did still just pay that $400 a month. Hell, man, let me take over your payments for $400 a month, and it's a nice house. I'll give you $10,000 in cash to walk away, and then I'm going to stick a tenant in there and rent it out for $1,200 a month.
So you'd be cash flow positive around $800.
And I never had to actually really close on the property.
Right.
But we'll sign a contract that eventually, when the mortgage is paid for in full, that I will get the deed.
Got it. And then, so in that case, if you gave him $10,000, right, you'd kind of make your money back the first year.
Sure. Yeah. I mean,
yeah,
absolutely.
And then it'd be cash flowing.
Then after that, it's 100% cash flow, and most properties don't cash flow for a few years.
Yeah.
So we've named off 3 forms of leverage. We have bank debt, we have like private equity debt, and then we have seller financing debt. So banks, where does the leverage come from? It comes from everybody in this room's deposits. They just turn around and lend them back out to other people.
Right.
Private equity, that's typically a real estate fund or a hedge fund that's going out there and raising capital from accredited investors and then turning around and leveraging that money from the bank and buying loans from originators like Steve and I. And then on the owner finance side, that's a seller finance type product. Are there any other types of leverage in real estate that you're utilizing today?
I have a question for you. What would you say the difference would be between subject to financing and what he just, Dustin just...
I think subject to is just another segment of owner financing, because the owner's financing you, but basically making you obligated to pay their mortgage payment and either a spread on top of that or some sort of cash consideration to get the lower interest rate you're financing or better financing terms than you'd be able to get through private lending or bank debt just because of the interest rate environment that we were in, early on in the pandemic.
And subject to is great and all, but if you're not getting any equity in the deal, it's so risky. There's all these gurus out there like subject to, and they're taking...
It's just a catchphrase now.
Right. It's a gimmick, in my opinion.
It's a fucking gimmick.
Yeah, and so, man, when those gurus online, subject to this, subject to that, I'm like, man, you might get 1 or 2 if you're really heavily marketing, but they're not just out there flourishing. And then if you don't get any equity in the buy, that's when the deal's made. It's on the buy. Yeah. If you don't have some equity in the property, what happens if they call the note, or what happens if a tenant tears the shit up?
100%.
Yeah,
so people don't listen. Who was the fucking guy, the Asian guy that I tore up on what? Thatch Win. So I fucking destroyed this motherfucker. Okay, on one of my reels, right? One of my stories.
What, did he comment on it, or did he just?
No. So all these fucking jerk offs that have nothing to do with this guy, right? They start commenting, protecting this fucking fool. And like as if it's their fucking father.
Guys that have probably never taken his course either, by the way. They just follow.
Even better. Yeah. They've probably paid this asshole money, right? Yeah. So now they feel like I paid this jerk off money. I got to protect them.
Got to be loyal.
If you got to see the stupid shit that they, that they say, and what is it that I pointed out, right? This fucking guy is on there saying, well, if you own 10 homes outright, and you're getting $2,500 tax free, and fucking you're clearing $2,500 a month, this and that. You're set for life. I was like, who the fuck is getting 10 homes that can cash flow at $2,500 a pop?
Right.
Nobody. With no mortgage, right? That was my fucking point to them, right? And these guys are coming back with the stupidest fucking remarks. The masses, right? Who was it? Hamilton? He said the masses are asses, right? So the masses, and every time I put something out like that, I realize the masses are asses, right? They just believe everything, and these gurus, right?
Right.
They have probably never. They don't have the fucking experience you have. No. The private experience, sure as shit that we have, right? And they just go out there and they're catchphrasing shit. like you said, subject to. That's like the fucking hot
Right.
word. And they're just abusing these fucking people, and these guys are falling for it, right?
And they're all in that same age group too. What, like I would say 20 to 24, 25.
Yeah,
because they're still very green, and they're very naive.
Right.
And so it's like for the longest time, everybody wanted to develop an app. It's like it's the same
thing.
shit.
We're back in the gold rush era, where the people making the money are the ones selling the tools, not the one actually mining for the gold.
Yeah.
And I'd say probably 19 out of 20 gurus that are out there are just selling BS coursework that has no success stories, and they're just purely making money off of selling coursework. There are a few guys out there, I'm not going to give you any credit yet, that actually have good content and set people up for success. But be very skeptical of these gurus, especially if they don't have a track record in the industry that they're in.
And we know some of the gurus, and we're going to have some of the gurus that are going to come on. Actually, this gentleman right here is one of the gurus.
Oh, thank you.
You got a course out.
I do, a wholesaling course.
A wholesaling course, and I actually took a look at it. Your shit's on fucking point, man.
Appreciate it.
Really.
Thank you very much.
And you're one of the few guys that me and Ross actually respect, because we see what you're doing, and you're actually doing it. So when it comes from somebody who's had success, that's put their fucking lives and their balls on the line and actually done something, that's the shit that we look at. Because, look, in the game that me and him are in, it's, everybody looks at the glitz. How much fucking stress did we go on there last week, bro?
Enough to kill an army.
Enough to kill an army, right? We had some serious stress. And people sometimes think, they're like, oh, you guys are fucking closing $30-40 million a month. You're rolling in cash. What they don't realize is fucking doesn't work that way.
It's acquired very painfully.
It's acquired painfully, but what they don't get is the more money you put out, the more fucking money you need, right? I got a question for you. Perfect example. Have we ever met a super ultra successful real estate investor with money in the bank?
Most real estate investors, the very successful high volume guys, they're leveraged through the gills. They're asset rich, cash poor.
Right.
And they're at high risk of losing it all at any point in time.
At any point.
And how stressful
they're fucking teetering,
is that
right? They're teetering.
Yeah.
And we know a couple of those guys, right? That have, those guys, and they've got portfolios, 50 million fucking portfolios. And sometimes they're calling us saying, hey man,
I don't have 12 grand in the bank to make my payments.
And we and him are looking at each other like, holy fuck.
You have $30 million of equity in your properties, and you can't make a $12,000 payment.
Truth. And where people from the outside are like, oh, this guy is fucking rich. Yeah, he is asset rich. Doesn't want to get rid of his,
right.
Which we
you
understand.
Shouldn't have to sell an asset to be able to make your payments,
Right.
That's
but shit sometimes happens, right? And then even for us, and a lot of people look at us and they're like, oh, these guys are lending money. What they don't get is the same thing that we're talking about. We also leverage. We don't have, $2 billion, to lend out in a year. Meanwhile, we're lending out $2 billion a year. Fact of the matter is, one of our partners, obviously the institutional investor, has $4 trillion or $2 trillion, and they could handle it. But for us, we're playing the same game. We're out there and OPM, but with the same game of leveraging, right? We're putting up $5 million. The bank is taking out $5 million, leveraging 20 to 1 and giving us 10 to 1, right? So they're using our money to lend it back out to us for a fucking spread, right? So they're borrowing it at 4%, lending it us at 8%, our own money, right? Basically, and they're arbitraging that shit, and they're lending it back to us. We understand the game, but that's just the way it's played, right?
Yeah, if we sat there and operated this business 100% in our own cash, we'd never get to the scale that we are today.
No, never.
So leverage has been instrumental from the beginning of the business to get to the volume that we're producing. Now, as the business grows, you retain more earnings, you build up your cash flow, you go out and raise real estate funds, other things to alleviate the need for a bank. But we started out with one small fund that financed the business, graduated to a larger regional bank, and now we have bank lines with 4 large banks, totaling over $120 million in debt that we work with and recycle through that debt monthly. And so, while we have to have cash in the business, we don't need to have $120 million in the bank. We can operate at those levels with roughly 10, 12 million in the bank.
Which is what we're talking about. So even for us, we're leveraging to be able to lend, right? Where you leverage to purchase, right?
Sure.
And even with us, we also have to be very careful, right?
Well, I learned the hard way right when I started. I'd been wholesaling for about 2.5 years, so I had created some cash and started marketing very heavily. You know, we're talking $20,000-$30,000 a month. So not only but I haven't leveraged any banks yet.
Okay.
And I went out and I spent all my cash buying rentals.
Right.
I'm telling you, when I started real estate, I was as green as they come. I learned every mistake. I could have read a book. I still wouldn't have learned the mistake. I had to make the mistake myself in order to learn it. And what happened was I used all my cash purchasing like 5 houses. That's all it was. Just one was a mobile home, a duplex, something else. But they were all nice houses that I was getting pennies on the dollar. Well, tax time comes around, marketing payments come around, $30,000 a month, and I'm going, shit. Like, what did I do?
Right.
But I'll tell you, the thing it taught me was to make sure obviously cash is king. And I still believe that, especially depending on where we're heading. I want to make sure I have a nice cushion in my bank account.
Right.
I don't want to be over leveraged. But one thing that situation did teach me, and it stressed me out. I mean, I have sleepless nights. How am I going to have to sell my property? Am I going to have to refinance my property in order to pay my taxes, in order to pay my marketing bills? Luckily, I got through it. I had a few big deals that got me out of the hole. But now I don't buy anything. The only time I spend my own cash is on a down payment, and maybe if it needs some hodgepodge, like here and there repairs. But everything else I'm using, I'm getting the bank's money.
Which is great. That's the way to do it. That's the perfect way to do it. Any other things to add on to this one?
I mean, just the outlook, heading into next year, as everyone in this room's aware, the Fed came out this month and telegraphed that they're going to start reducing rates, in September. I still think that they were late to the ball game. The non-farm payroll data was overstated by 50%. I think almost 900,000 jobs more than they predicted. Unemployment's creeping up to 5%. Inflation's trending down to low 2s. We are headed into a recession, whether anybody believes it or not. And I'm not trying to strike fear in everybody. I think it'll be a mild recession. But if they would have started these rate cuts in May, or June, when they should have, we wouldn't be in this position right now. But they have a lot of tools at their disposal, being that interest rates are almost at 6% on the Fed fund rate. They can come down pretty aggressively to stave off a recession. But it's a good sign for us in the lending world. As rates trend down. We have a lower cost of capital. We can lend out money less expensive to our real estate investors. Lower rates should bring more people into the market to buy and also to refinance their mortgages. 2025 is going to be the year of leverage again. I think it's going to be similar to 2021 where we really went out there and crushed it. But we have a much more mature business this time around, a lot more resources at our disposal, bigger investors behind us. So, I want that $2 billion mark next year.
100%. I think one thing I'll say, you're right. They've been too slow to lower, just like they were too slow to higher, right?
Yep.
And that's what fucked up the whole situation in the first place, right? When they should have started hiking up the rates, they didn't. And then when they should have started cutting the rates, they were too
it's
slow.
Because all this data, whether it's payroll data or inflation data, it lags almost 2 months. Yeah. And they're waiting for the information to get published. And then there's a period of corrections where they audit the information and get it. Yeah. And, there was a lot of just, news in out there that was positive at the time, but was actually negative in the present state. Any American was feeling inflation was getting out of control, that home prices were rising at too high of a rate, and that there was going to be an issue to deal with if we didn't jump in and deal with it. And they waited too long. And then they hit us with huge rate hikes, 75 basis points, 75 basis points, 50. It was just like death by 1,000 cuts, but we weathered the storm. A lot of our competitors went out of business. A lot of real estate investors failed. It's less competition for Dustin, less competition for Steve and I, and we're in a much better position than we were prior to rates going up, and we are today, and we're ready to go out here and crush it and take over the market.
I'm blessed. Bye, everybody. Remember, look at the link below, like, follow, and we'll be back.
Cash flow is coming.
Cash flow is coming. You've been listening to The Game of Loans, where real estate battles are fought and won. Make sure to fortify your defenses by subscribing. Cash flow is coming, and we'll be back next time to help you claim your throne. The war of wealth continues.